Good morning and welcome to TOITOI Japan Market Radio. I'm your host coming to you from Tokyo on December 3, 2025. This show is designed for global investors tracking Japan's equity, currency, and fixed income markets. Today we'll walk through the latest price action and dive into some key themes shaping Japanese assets right now.
Thanks for having me. Let's start with where we closed today. The Nikkei 225 finished up 1.138% at 49,864.68, showing solid momentum in the large cap space. However, the TOPIX told a different story, down 0.143% at 3,496, reflecting some underlying weakness in the broader market. The Mothers Index dropped 1.223% to 2019. And the J-Right Index declined 0.395% to 2018.0, so we're seeing some pressure outside the main index heavyweights.
And on the currency and commodity side?
USD JPY traded at 155.424, down a modest 0.086%, so relatively stable there. Gold in yen terms came in at 15605, down 0.16%. While crude oil rallied 0.952% to 59.4, reflecting some firming in the energy complex. Overall, it's a mixed picture with divergence between the headline Nikkei and the broader market breadth.
That divergence is really the story today. Let's dig into what's driving that split, because the Nikkei's rally is masking some softer undercurrents. We're seeing technology stocks leading the charge, tracking strength from Wall Street overnight, but the banking sector is weighing heavily on the TOPIX. What's your read on this two-speed market?
It's a classic case of Japan's structural exposure playing out in real time. The Nikkei is heavily weighted toward large-cap exporters, particularly in semiconductors and electronics, and those names are benefiting from the global AI and tech spending cycle. When you see momentum on Wall Street, especially in tech, Japanese exporters tend to follow that lead. On the flip side, the banking sector weakness is dragging down the TOPIX, which has a much broader composition including domestic financials. That tells us investors are rotating out of domestic cyclicals and questioning either the Bank of Japan's rate trajectory or concerns about net interest margins and credit conditions.
So for global investors, this really highlights the divide between Japan's multinational champions and its domestic-facing sectors.
Exactly. If you're overweight the Nikkei, you're essentially betting on export resilience and global demand for Japanese technology. But if you're looking at the TOPIX for broader exposure, you need to pay attention to what's happening with domestic economic momentum and policy expectations. The banking sector comprises roughly 25% of the TOPIX weighting, so sustained weakness there can significantly impact overall market breadth. This isn't broad-based strength, it's rotational, and that matters for portfolio construction.
And how does this divergence play into currency and rates?
On the yen side, the tech rally by itself might be neutral to slightly yen negative if it reflects risk on sentiment and capital chasing higher yields abroad. But the banking weakness introduces uncertainty about the Bank of Japan's policy path, and that can weigh on the yen if investors perceive the BOJ as boxed in or hesitant to normalize rates. For JGB yields, today's sector-specific weakness doesn't signal broad macro deterioration, but any deepening concerns in the banking sector could eventually push investors toward safe haven JGBs, capping yields. That said, the bigger picture on yields is shifting rapidly.
Staying with the policy side, we're seeing some significant developments around Japanese government bond yields and the Bank of Japan's stance. Reports today highlight that Japan's services PMI has strengthened, which would normally be a positive signal for the economy. But at the same time, JGB yields have surged to their highest levels in 17 years, and the BOJ is reportedly eyeing further rate hikes. This feels like a critical juncture.
It absolutely is. The services PMI strength gives the Bank of Japan more ammunition to argue that the domestic economy can handle tighter monetary policy. Services have been a resilient part of the Japanese economy, and continued strength there supports the case for normalization. But the 17-year high in JGB yields is a double-edged sword. On one hand, it reflects market expectations that the BOJ will indeed hike rates further, which is a sign of policy credibility. On the other hand, rising yields create immediate financial conditions tightening, which can constrain domestic consumption and investment even before the BOJ pulls the trigger on another hike.
So the market is front-running the BOJ's intentions.
Correct. And this puts the BOJ in a delicate position. If they move too quickly or signal aggressive tightening, they risk destabilizing financial markets and derailing the recovery. But if they hesitate, they lose credibility and yields could spike further as investors price in inflation or fiscal concerns. The yield curve control framework, which has been the cornerstone of BOJ policy for years, is clearly under pressure. That framework may need recalibration sooner than the market anticipated just a few months ago.
And for investors watching from abroad, how should they think about the equity, FX, and yield implications of this policy crossroads?
Let's break it down by asset class. For equities, it's a mixed bag. The services strength is fundamentally positive for corporate earnings, especially in domestic consumer-facing sectors. But rising rates typically compress equity valuations, particularly for growth stocks and rate-sensitive sectors like real estate and utilities. Financials, though, could outperform if higher rates translate into improved net interest margins for banks, assuming loan demand holds up. On the FX side, this is unambiguously yen positive. Higher rate expectations and elevated JGB yields increase the carry cost for yen shorts and make yen-denominated assets more attractive on a relative basis. We've already seen some stabilization in USD, JPY, and if the BOJ follows through with a hike, we could see the yen strengthen further from current levels around 155.
And yields themselves?
Yields are likely to remain elevated in the near term. Even if the BOJ acts to stabilize markets, the normalization trajectory is now embedded in investor expectations. We're unlikely to see a sharp reversal unless there's a significant deterioration in economic data or risk-off shock that drives a flight to quality into JGBs. For global investors, this means Japanese government bonds are no longer the zero-yield trade they were for the past decade. There's actual income now, but also real duration risk.
Shifting back to equities for a moment, we've talked about the sector rotation between tech and banks, but what does this mean for overall market sentiment going into year-end?
Year-end dynamics are always tricky, but the current setup suggests we'll see continued volatility and selectivity. The Nikkei's resilience is encouraging, especially if global tech demand holds up and earnings revisions remain supportive. But the TOPIX underperformance and weakness in smaller cap indices like the Mothers Index suggest that domestic confidence is fragile. Global investors need to be selective here. It's not a market where you can buy the index blindly and expect broad participation. You need exposure to the right sectors and the right names, particularly those with pricing power, global revenue diversification, and resilience to higher domestic rates.
So the two-speed Japan narrative is really playing out in both macro policy and micro stock selection.
Precisely. And it's worth noting that this divergence isn't new, but it's becoming more pronounced as the BOJ moves closer to policy normalization. For years, ultra-loose policy lifted all boats. Now, as that tide recedes, you're seeing which companies and sectors have genuine structural growth versus those that were simply benefiting from cheap money. That's a healthy process long-term, but it requires active management and careful attention to fundamentals.
Before we wrap, let's recap the main themes global investors should be watching in Japan right now.
Sure. First, the split between export-oriented tech and domestic cyclicals, particularly financials. This tells you a lot about where confidence sits and where capital is rotating. Second, the Bank of Japan's policy path and the pressure on yields. We're at a 17-year high in JGB yields, and the BOJ is signaling it may hike again. That has significant implications for equities, the yen, and portfolio allocation. Third, services sector resilience, which is a bright spot but also complicates the policy calculus. And finally, watch USD, JPY closely. Any further hawkish signals from the BOJ could push the yen materially stronger, and that has knock-on effects for Japanese exporters' earnings.
Great summary. As always, we're not here to give financial advice or recommend specific trades, but these are the key themes and data points that matter for anyone with Japan exposure. If you follow Japan's markets and want daily insights like this, consider subscribing to TOITOI Japan Market Radio. Thanks for joining us today, and we'll see you tomorrow with the next update.
Thanks, and good trading to everyone.